The broadcast is now starting. All attendees are in listen-only mode.
Hello, everybody, and welcome to today's re-recorded webinar, How to Successfully Manage Real Estate Investments While Using Self-Directed IRAs. I'm Erica Figueredo. I'm the marketing specialist here at Next Generation, and I'll be monitoring the webinar today and fielding any relevant questions to our speakers. So we have a very exciting session ahead. So for anyone that didn't have time to make it live, or if you just want to go back and watch the session again, this re-recorded webinar will be available for on-demand viewing. And just to kind of point it out, obviously we apologize for any technical difficulties we had during the live session, and we're keeping our fingers crossed that we don't have any technical difficulties today. So with that being said, any questions that were asked during the live session will be addressed today. But before we get started, I wanted to take some time to reintroduce our speakers and tell you a little bit about our company. So first and foremost, we have our co-host, Naveed Musa. In addition to his real estate profession, Naveed is an entrepreneur, agentor, and wealth building creator. He is the owner of Mr. Save a Home brand and creator of the training, Becoming an Agentor, the Basics. He's also the owner of a real estate brokerage that focuses on educating investors to grow their wealth through real estate and performs one-on-one training with the agents on how to create win-win situations for their clients for all their real estate needs. Naveed has a generation of knowledge with 20 years of experience in real estate and has navigated through 2 economic crashes successfully. And secondly, we have Brittany Melville, who's our Director of Marketing and Sales. Brittany leads sales and marketing efforts here to promote education on self-directed IRAs and oversees the team responsible for helping investors set up their accounts to make alternative investments, which include real estate, private equity, lending, and more. So now that we've introduced both presenters, I'll briefly touch on who Next Generation is and what we do and don't do. Britt, if I could have the next slide.
Oh, sure, I'm sorry.
I realized I didn't have screen control. So who is Next Generation? We're a custodian and administrator for self-directed retirement plans, pretty much like your typical retirement plans, except you can include alternative investments. Like we said before, real estate, private equity, lending, cryptocurrency, precious metals, a lot more. What we're not is a bank. We're not a brokerage. We're just neutral third-party professionals who, number one, custody the accounts on the Next Generation Trust side, and then provide administration for those accounts on the Next Generation Services side. We don't endorse, recommend, sell any investment products, or obviously endorse, recommend any investment products or any other services products in general. And we also do not give investment or tax advice. Instead, we offer education, which is part of our mission, and our white glove customer service is to obviously ensure that our clients have the knowledge to be able to use their accounts successfully. So with that being said, we also have a quick disclaimer, which I briefly touched on before, but just to review that once again. Do we have it? Is it there?
Here it is.
There we go.
Sorry.
So Next Generation does not review the merits or legitimacy of any investment. We do not endorse or recommend any companies, products, services, or investments. We are not a fiduciary. So obviously, like I said before, we're not providing any financial tax advice. And all of the information provided in today's session is for educational purposes only. So with that being said, Britt, I'll give the floor to you, and any questions that come in, I'll field them to you guys.
Great, thank you, Erica, for the introductions. Welcome, everyone. Thanks for giving us your time today to learn more about managing real estate investments in self-directed IRAs. We're going to aim for this to be more engaging and conversational, but there are certain concepts about self-directed IRAs that I'd like to cover. So I will do that, and then Naveed, if or when you have any commentary or questions, feel free to chime in, and we can talk through it from there.
Sure. Yep.
So just to back up real quick, Erica did an introduction on the company. Just a bit more background information on the story and how the company came to be. We are a women-owned business in northern New Jersey, and we're founded by Jamie Raskolniks, who was or is a real estate investor herself and has a lot of real estate experience. So in her quest to find a way to put real estate investments in her retirement account, she came across the self-directed IRA, became very passionate about this as an investment and wealth building strategy, and wanted to share this with many others who have not heard about this strategy. So she founded the company with the intention to do that, and we've been in business for 16 years providing these services. So the question for anyone who's new to the concept, or maybe you've just heard through word of mouth about self-directed IRAs, but you're not quite 100% sure what actually is a self-directed IRA and what makes it different. So self-directed IRAs work similarly to other IRAs that you might have from a tax perspective. However, one of the biggest differences with self-directed IRAs is what you can invest in. So typically, in the IRAs that we're most accustomed to hearing about and having, we're restricted to investing in public securities. So anything publicly traded on the stock market, stocks, bonds, mutual funds. With a self-directed IRA, your options are expanded to include non-publicly traded, what we call non-traditional alternative assets. So those would include things like real estate, which we're going to talk about today, and we're going to also talk about some other things that you can invest in with a self-directed IRA that you normally wouldn't with a regular one. The other differentiator with using a self-directed IRA to make these types of investments is that your investment earnings are then going to either be tax deferred or tax free. So there's a tax benefit to using the IRA to do these alternative investments. And then the other idea behind this is giving you more control over your investments that you choose. Because they're self-directed, you decide what investments you want to make for yourself in your IRA. It's also going to give you, ideally, more control over your return on investment. If these are things that you're investing in outside your retirement account and you've been very successful, you feel very comfortable doing it, you know what types of returns that you're going to expect. If you think they're higher than what you'd be getting in the market with stocks and bonds, then you can certainly apply those things to an IRA. And the idea being that you're going to accelerate your investment returns as well. So the case behind the importance and growing interest in self-directed IRAs is this retirement landscape that we're seeing changing dramatically over this generation. Many workers or many adults over the age of 65 or retirement age have continued to remain in the workforce because they don't have enough money saved to retire. So it used to be that Social Security could be relied on as a sole source of retirement income. That's no longer the case. It also used to be that pension plans and other types of employer plans, like defined benefit plans, were more common. And with those, you'd pretty much be set once you retired. But now we're not seeing that. We're seeing a lot of people getting 401ks, which is good, but they're not offering the same types of security long term. So what this is doing is putting the onus on us as individuals and investors to say we have to take more control over how where we're putting our money in terms of investing for retirement. And the alternative space has seen growing interest in recent years. So there's a lot of interest in people getting more involved in taking control over their own investments, which is something that a self-directed IRA will allow for. So when we talk about the types of plans that can be self-directed, there's not just one type of self-directed IRA. These are the plan types that you may be familiar with or may have seen before. So even with IRAs that aren't self-directed, there's the traditional IRA, which is basically going to be tax-deferred investing. That means that all your money is going to go into the traditional pre-tax. You can typically deduct that on your taxes, the money that you're putting in. And then as you invest those dollars and you grow, the earnings on your investment are going to go back into your traditional IRA, and you're not going to be responsible for paying tax on any of those earnings until later down the line when you decide to start taking money out of that traditional IRA. A Roth IRA is going to work sort of the flip side of that. So your money goes into a Roth after tax, meaning that it's not tax deductible. You're paying tax on it up front. It's taxable money that goes into the Roth, and then anything that you earn on investments in your Roth IRA is going to be actually tax-free. So if you put $10,000 in a Roth, you invested it over the years, you grew it to $50,000. So you had $40,000 in earnings. That $40,000 in earnings you will never have to pay tax on, as long as you take the money out of the Roth at the appropriate age. So after the age of 59 and a half, you're no longer subject to a 10% early withdrawal penalty. You can make those withdrawals tax-free, which is a beautiful tool to consider for retirement planning. And then I know, since we have individuals interested in real estate here, you may be self-employed. So you may have your own business or an LLC, or maybe you're an agent, so you get paid on a 1099 basis. So for anyone who's considered and falls into that space, there are several types of IRAs or other types of retirement accounts that are designed for you. The SEP IRA is going to allow you to basically set up a tax-deferred IRA that's tied to your business. So the biggest difference between that and a regular traditional tax-deferred IRA is that with a SEP IRA, you're able to stash away more money on an annual basis put into it. So what the IRS calls those contribution limits, personal contributions that you can make into your own IRA out of pocket. For a SEP, it's calculated as 25% of your compensation from that business, up to and max out at $57,000 per year. So that is a much greater potential to get money into your IRA if you're self-employed, versus if you have a traditional or a Roth IRA. Typically your annual contribution limit is going to be $6,000 per year, or $7,000 if you're over the age of 50. So the simple IRA and then other types of qualified plans are also good for business owners. And the qualified plans, like if you're self-employed and you wanted to have a solo 401k, those also allow greater contributions, and then you can match your contributions through your business. So there's a lot of potential to get money into them to then start investing and then grow it over time. If you haven't started yet, it's never too late to start. And then there are two other types here: education savings accounts and health savings accounts, that are not technically retirement accounts, but they're tax advantage plans that can be self-directed. So you can use those funds to invest in alternatives like real estate and private equity, for example. And then your withdrawals with the ESA, if you're using them for your child's education expenses, they would be tax-free. And of course, with an HSA for medical expenses, they would be tax-free as well. So ways to get money into a self-directed IRA to start investing. You can make a personal contribution. So we just talked about some of those limits. The IRS sets those, and they're limits that you can put in on an annual basis every year. Basically taking funds from your checking or savings and then depositing them into a retirement account. The other very common way for people to fund new self-directed IRAs is to transfer funds from an existing IRA that you might have that's not a self-directed one. So let's say, for example, you have an IRA at Fidelity and you wanted to move some of those funds into a self-directed IRA to do real estate projects. You would be able to have Fidelity transfer some of those funds from your existing account to your new self-directed IRA without any penalty or any tax reporting required, or any taxable event, as long as those are two similar IRA types, like traditional to traditional, for example, Roth to Roth. So you could do that in order to get cash into your self-directed IRA and get started. Or also very common, and I think Naveed had mentioned that a lot of the investors that he spoke to in his network, you had mentioned that they have usually old 401ks or old employer plans. Is that right?
Yeah, a lot of the times they'll have the 401k and they'll want to switch it over. The number one question I think I get asked outside of that is there a penalty when they do that, when they roll over? Is there any kind of consequence that way?
Right, yeah, that's a good question. So as long as that rollover is taking place so that the funds leave the old account and then they're deposited into the new account within a 60-day time frame, then there is no penalty or any tax or anything like that. Now, a rollover does get reported on tax forms, but that doesn't mean that you're responsible for paying tax. It's just letting the IRS know that funds left this account and then they were deposited into another. Typically, most rollovers are done as direct rollovers, meaning that the funds are going to leave. Let's say you have an old 401k with Vanguard or just thinking of it. What was that?
So you can use Fidelity or
Yeah, Fidelity too. So if you have an old 401 with one of those custodians and you request a direct rollover to your self-directed IRA, what they're going to do is they're going to take the funds and they're just going to either write a check and mail it directly to your custodian of your new IRA, not to you personally, or they can also directly wire the funds. So you're never really taking receipt of the funds. However, sometimes indirect rollovers are done, in which case they would cut a check to you personally, and then again within that 60-day time frame, you're responsible for making sure that that gets deposited into your new account, just so that you're not.
Do all the funds have to come over, or can, like, what if someone want to say, hey, listen, I want to do this, but this is new, so I'm a little bit scared. Do that? Can they just take half or a percentage of the 401k rollover, or does all of it have to come over if they do that?
They can do a partial rollover, so it's completely up to you how much you'd like to move out. But that does bring up a point about eligibility, rollover eligibility. So when we're talking about 401k rollovers and rollovers from other employer plans as well that fall into this category, so like a 403b or a 457, those would also be considered old employer plans that could roll over. When we say old, we mean inactive, as in you're typically no longer working for that employer in order for you to be able to roll over the funds. If you're still working for the company, there is a chance they might allow for what they call in-service rollovers, but your best bet would be to contact the administrator of your old plan and then ask them, is this eligible to roll into an IRA? Can I roll it over? And when I say administrator, go ahead, Newt, sorry.
No, I said okay.
Okay. And when I say administrator of your plan, if you're not sure who that is, your best bet would be to either look at a statement. If you're still getting statements in the mail for that 401k, the company that's sending them is your administrator. So it might be like Voya, it might be Alaris. There are many other third-party administrators that handle 401k and employer plans. But if you're not getting statements and you're not sure, you could always call up the HR department of your former employer and just ask them, who could you contact to get information on your plan, and they should be able to tell you that. And then the last way to get funds, in addition to the others that we mentioned, is if you had a tax deferred plan and you move those funds into a Roth, which is not tax deferred, it's tax free, then that movement is called a conversion. And that does create a taxable event because you're taking pre-tax funds and you're putting them into an after-tax account. So in the year that you do that conversion, you're going to be responsible for taxes on the amount that you moved and converted. But then after that year, after you're responsible for that tax tax on funds you moved, it grows tax-free from there. So these are all the different ways that you could fund an account. You can do combinations of these things to get funds into an account. You can roll over and you can make a contribution to an account. You could transfer and make a contribution. It all depends on what you have available and what it is that you'd like to do to get started. So possible investments, this is where it gets interesting. Did you have a question? I'm sorry.
Nope. Okay.
So possible investments, we're going to talk about real estate. I know that's a big area of interest. And even within that category, there's a ton that you can do and structure in different ways. So we'll get into that further shortly. But there's also mortgage notes, tax liens. When we talk about private placements, we're talking about private equity. So you could use a self-directed IRA to invest in a private company, a startup company. You can purchase private stock in a company, even if it's pre-IPO, There are a lot of investors that do that as well. Hedge funds could be domestic or offshore, partnerships, syndications, precious metals like gold and silver, for example. If you're forming a JV for a real estate project or any other investment project, you can utilize the IRA as a partner. Private lending is another huge one. So the IRA can act as a lender, and we'll talk more about that as well. And then international investments, which could include foreign real estate or foreign currency, for example, cryptocurrency, which is again back in the limelight right now, and there's a lot of growing interest in that space. And then social impact investing, which similar to kind of the private equity approach, but investing specifically in companies and causes that are meaningful to you. So the IRS allows all these things with the exception of just two things, life insurance and collectibles. So those are the only two things that you can't purchase and hold within an IRA. Oftentimes we get the question, what do you mean by collectibles? So anything that might be like an antique, like an old art collection, antique cars, baseball card collections, coin collections, a wine collection, anything that would basically just grow in value over time just from sitting there in that sort of collectible fashion. So if what you're interested in does not fit into those two categories, then it is game for consideration. So we're going to talk now, getting more into the real estate side of things, about 3 different ways you can look at this. And most people think, okay, if I'm going to benefit from understanding self-directed IRAs, then I just have to have my own self-directed IRA, do my own investments with my own account, and that's the only way that this applies to me. But that's not necessarily true, because one of the ways that investors can benefit from this is understanding that there's a ton of money held up in self-directed IRAs that are looking for investments. So on the flip side, if you have an investment, or if you have, you own your own company and you're looking for capital, or you're looking to borrow money and you're looking for investors or lenders, self-directed IRAs are one place where you can look, or you can speak with individuals that either have self-directed IRAs, or if you and your network have individuals that are interested in investing with you, but maybe they either don't have enough cash on hand personally, or they don't want to use all the cash they have on hand. But let's say that they have money tied up in their retirement account and they'd be open to doing that with you, then understanding this approach is important, because you can educate them at least at a high level on this option. And then of course, connecting them with a self-directed IRA company can further educate them and help them to get an account set up to invest with you. So this can be done in the form of notes or loans, in which case, if you are on the receiving end of the funds, then a self-directed IRA would be your lender. And then you would borrow those funds either personally, or if they're lending to a company that you own, those notes can be secured or unsecured. You basically decide on the terms with the lender / IRA. And then you would ideally be paying back that IRA directly, principal and interest, or if it's equity based and you're going to provide them a percentage of what you're making on the deal, then you can do that as well. And then the other way to receive that capital from a self-directed IRA is through the more of the direct equity investment, where the IRA is either going to take partial ownership of your fund or your company, or purchase stock in your fund or company. It can be as a limited partner or forming a joint venture, and then the IRA is going to receive its return in accordance with however you set up the terms. Again, just the big thing to keep in mind is that all the investment returns associated with the IRA's investment have to go back into that IRA. So that's how the IRA will build its value, maintain its tax advantage status, and avoid any taxable events or penalties.
I have one question from the audience that I think might be relevant here. They want to know if you as an individual can partner with your own IRA to buy something.
Great question. The short answer is yes. There are some stipulations if you are partnering your self-directed IRA with your own personal funds. So I'll say the short answer right now is yes. And I'm going to talk in a moment about some rules and regulations that are really important to be aware of that the IRS puts in place. So when I get into that, I will dive into that a little bit further in terms of if you are partnering with yourself, what you should be aware of and the guidelines to follow to make sure that you're doing it properly. So hopefully that helps for now. So then on the flip side of what we just talked about utilizing other people's self-directed IRAs, but then of course if you did want to have your own self-directed IRA set up and you wanted to invest more passively, you could do lending to individuals or companies. So it's going to be the same as what we just discussed. Notes can be secured. Then the IRA, your IRA is going to earn principal and interest or some equity. And again, all the returns flow directly back into the IRA. So that means that this is why having a custodian for your self-directed IRA and an administrator is important, because you're not personally taking receipt of the funds in order to invest them. You are directing the custodian who's going to act on behalf of your IRA to send those funds out of your account to the borrower. And then when the borrower submits a payment, it's going to go back to the custodian that's going to then deposit that payment into your IRA for you. So by taking a hands-off approach, you're able to utilize the account without triggering any taxable event. And then the last strategy is using your own self-directed IRA to actually directly hold property. So some individuals would like to directly purchase real estate in the name of their IRA. So that can be done. It can either be done in the name of your IRA as the owner, or if you wanted it to be under an LLC, your IRA could then invest in, as a member, a newly created LLC, and then the LLC in turn purchases the property. In terms of financing and cash flow, because we get this question a lot, depending on the price point of that property, you can either purchase it in cash, if you have cash available to do that. You could either, if you needed financing, you can get a mortgage, or you could borrow from a private lender. However, any loan associated with an IRA's purchase of property or real estate investment has to be non-recourse, meaning that if the IRA defaults on the loan, the lender's only recourse is to foreclose on the property. So the only collateral is that property that's being leveraged. The loan cannot be personally guaranteed, and there can be no other assets that the lender could go after. They can't go after any assets in the IRA or the actual account holders. As Erica had brought up a question earlier about partnering, you could also partner your IRA if you don't have enough cash in your IRA to be the sole owner of a property. You can partner up with another IRA, another buyer, multiple other buyers, another company. You can get sort of creative there with your different options. And then of course, if you could either do a fix and flip project or buy and hold. So fix and flip is going to be a little bit more involved because you're going to have probably more transactions taking place to purchase supplies, items, paying contractors. There's more activity involved, but that can be done. And when in turn you finally turn around and sell that property, all proceeds from sale are going to go back into your IRA, and then you're not responsible for capital gains because it's going back into the retirement account. And then if you decide to buy and hold, any of that rental income is going to be your passive income flowing into your IRA. And again, you're not going to be responsible for reporting that on your taxes as long as it's in your IRA. So the partnering we talked about, and then as you can see here, you can partner with your personal funds. We're going to talk more about rules in a moment here. And of course, that is an alternative to the financing if you didn't want to do the non-recourse loan. Okay, so here's where we get into some additional rules and regulations that are important to understand. So the IRS allows investments with the IRA. However, there are certain transactions that they deem prohibited, and that they define as basically an improper transaction between an IRA and then what they call a disqualified person. So I'm going to skip ahead real quick and show you what that means. So Disqualified persons are considered yourself as the IRA holder, any spouse, ascendants, descendants, and their spouses. So if you look at your family tree in like a lineal direction, any of those relationships, grandparents, grandchildren, etc. Those are considered disqualified persons. And in addition here, you can see like anyone servicing the account like an advisor or your self-directed IRA custodian, any companies that are majority owned by a combination of disqualified people, so 50% or more owned by any of these relationships or individuals as well. So what this is basically saying is that your IRA cannot directly do a transaction with any of these individuals. That means buying from one, selling to, lending to, borrowing from, or doing anything else that's going to directly benefit that individual as a result of the IRA's investment. So this is where the IRS categorizes prohibited transactions into 3 types. So per se is going to be a direct transaction, like I just mentioned. For example, let's say you purchase a property with your IRA, and then you wanted to sell it to one of your children. Unfortunately, the IRS wouldn't allow you to do that because your children are disqualified persons, and you cannot sell anything from your IRA to a disqualified person. Extension of credit refers to similarly that, but when we talk about lending, so same thing. You wouldn't be able to. Sometimes we get the question like, can I lend myself money out of my IRA? Because you personally are a disqualified person from your IRA, you're not able to borrow money from it directly. And then self-dealing is sort of like a gray area. This is a case where you might maybe, for example, use your self-directed IRA, you invest in a company, but you personally, providing services for that company as well. So you're also getting paid compensation personally. And then your IRA's investment affects your personal compensation. So there's a little bit of conflict of interest there and some commingling potentially. So those types of investments are not really ideal for a self-directed IRA. Typically, if you're going to be using the IRA, it should be sort of like an arm's length transaction, purely investment purposes. You're not trying to, mix it in with your personal investments. However, to the earlier question, if you did want to partner with yourself, you could. However, the restriction there is then going to be that when you partner, because you're disqualified from your own IRA, you and your IRA have to fund that investment simultaneously from the very beginning. So you have to go in as partners from the start, decide what percentage of that investment is your IRA going to own, and then what percentage are you going to own. And then whatever percentage split you agree on from the beginning has to remain consistent throughout the entire investment project. So that comes into play when we talk about like expenses for an investment. So for example, you purchase real estate and you have property taxes, right? So property taxes and the maintenance, repairs, et cetera, have to be paid out of the IRA if the IRA is going to own the property. But if you're partnering with yourself in your IRA, then each of you owe a portion of that, depending on what your ownership percentages are. Same thing with any earnings that are going to come back in if you've partnered with your IRA. And let's say, for example, it's a 50-50 partnership, and then you sell the property and you get $100,000 in proceeds. 50,000 is going to go to your self-directed IRA. It's 50%, and then the other 50,000 would go to you. Of course, the 50,000 that goes to the IRA is going to be tax sheltered, and then the 50,000 that goes to you personally is going to be taxable depending on your circumstances. So hopefully that helps clear that up a little bit.
So real quick, I'm sorry, just to so the first bullet point for the per se, because I don't want to confuse anybody. When it says IRA holder yourself is disqualified, just want to clarify, people, you can still buy a property in your IRA's name. You just can't loan yourself the money. You can't take a loan from your IRA to yourself to then go buy a car, for example, but you yourself could take money out of your IRA, use those funds to buy a flip or a property, like a rental. Is that accurate?
Yes, as long as you're not like physically taking the money out and then sending it to yourself and then investing with it. But yes, absolutely. Like you as the account holder have the control over what you want to invest in with your own IRA, and you call the shots. So you're making the decisions. But as far as how the funds are moving logistically, that's where the custodian comes into play to to take those funds for you per your direction, and then do the transaction where they're going to send the money out for you. Hopefully that.
Yeah, that's fine. I just want to make sure because I'm sorry. Go ahead.
No, it's fine. I have, I guess, an extension of a question to that question from our audience, which I don't know if we want to get too in depth with, but I know that we have at least some information on it. So they want to know if they only are investing a portion of funds for an investment through like a flip, as in they're partnering either with themselves or with somebody else. How is that money getting put back into the IRA decided? Like they want to know how we know to put that amount back into the IRA if there is a partnership.
Okay, like how we know what the split
Yes.
might be, for example. So at the beginning of the investment, once an account is open, the self-directed IRA is open, and the account holder is directing us to make an investment, there's some internal paperwork that we're going to ask them to complete. And we're going to ask if it's a real estate investment, for example, what's the property or address of the property, closing agents, contact information. If it's a partnership, we are going to ask there what percentage is going to be owned by your IRA. So that way, when payments are coming in, we're checking that against, are we getting the right amount in accordance with the percentage that you told us your IRA should own. So that's one way that we as a custodian look at that and sort of track that information. Hopefully that helps answer the question.
Yes, thank you.
Sure. Navi, did you have anything else that you wanted to add there?
No, the other thing was about the paperwork you had said when you take ownership, people to kind of clarify, you can borrow from your IRA and you can invest you can partner with yourself. So the paperwork would look like it would have the IRA's name and my name, for example, right? It would basically, that's how you're taking ownership, just to clarify that. When you're investing with yourself, it's your name plus your IRA's name goes on the documentation for the loan documents.
Correct, yeah. Okay. So on the actual documentation, the buyers would be yourself, like if you're partnering with yourself, the buyers would be your name personally, like Navi Musa. And then if your IRA is going to be the other buyer, then it's going to be named on the document as, for example, we have a naming convention for each IRA. So it's going to look like Next Generation Trust Company as custodian for the benefit of Navi Musa IRA 1234. So it's going to indicate that we are everyone that's involved in the investment is going to indicate that we are acting as custodian for this IRA. The person's name is the account holder, and then there's a 4-digit account number that would be needs to be included on the documentation. So that is very clear.
Thank you.
Sure. All right, so we talked conceptually about prohibited transactions, but here are a couple more specific examples as it relates to real estate to kind of put this in perspective. So, of course, we talked about the fact that these really should be for investment purposes only. If your IRA owns a property, then it is responsible for paying expenses associated with the property. So you're not, if you purchase a property with your IRA and you don't have any personal ownership, then you're not later coming in and trying to personally pay for expenses. Same thing with providing services like sweat equity, like doing any of the repairs yourself or adding value in the form of like maintenance or just any of that. When your IRA owns a property, or even if your IRA just owns a portion of the property, you're not allowed, or no disqualified person, I should say, is allowed to do sweat equity. So that just means that if you need work to be done on the property, it just has to be done either by a contractor that you hire. If you're using a property management company, it's probably a non-issue because you're not doing it yourself anyway. Or Other option is if you really quick needed somebody to come take care of something and you didn't have a contractor or somebody that you could call, any other person that's not a disqualified person. So like even if it was your friend and you needed them to come and fix something for you, and then your IRA pay them for that, that's fine, as long as it's not any of those disqualified persons on the list. Same thing with like who you allow to rent that property that's owned by your self-directed IRA or use it or live in it can't be a disqualified person. So it really should be just unrelated tenants to you. And then the last one, which this comes up a lot as a topic of misunderstanding sometimes, is we might have someone come to us and say, I want to use my self-directed IRA to buy this property, but I found the property already and I signed a contract and I put down a deposit in my name, but now I want to move it into my self-directed IRA. Once you've begun the process personally, since you're a disqualified person, you're not able to then like transfer that into your IRA because now you've already got the wheels in motion to give your IRA an advantage to get that property now by putting down a deposit, by signing that contract personally. So ideally, if you want your IRA to purchase real estate directly, your best bet is to get the IRA set up in advance, and then as soon as you find a deal, everything should be in the name of the IRA from the beginning. So all of the documents, the contract should have the name of your IRA as the buyer, and then the custodian is going to sign those documents for you. And same thing with deposit. Deposit should come from your IRA as well. So these are just a couple examples of things that you have to just be a little bit more mindful when IRA is involved. Because of the tax advantages, it's going to require a little bit more thinking through, but of course your benefit is the retirement wealth building and the tax benefits, but you just have to make sure that you're going through the right channels and following the right guidelines. So to wrap things up before we get into any questions, usually the next question we get from people is, okay, if I wanted to do this, like where do I start and what are the steps I need to follow and how long does it take to do that? So the first step is getting an IRA established, a self-directed IRA set up, a new one. And that would just require filling out an application. Everything is typically electronic now, and that can be opened within 1 to 2 business days. And then the second step in the process is getting the funds into your account. So earlier we talked about different ways you could do that, through a contribution, through transferring from another IRA, rolling over from an old 401k or employer plan, or moving funds from a traditional to a Roth. But this is going to require a little bit of paperwork and moving parts, working with your current institution to get the funds moved out. So it can take anywhere from a couple of days or a few days to usually a couple of weeks. The variable, we're very conservative on this, which is why we put 1 to 6, but the variable usually that we don't have control over is just the other institutions' processes and their time frame. So if they're holding on to your funds and we need to get the funds into the self-directed IRA and they take a week to send them, then that could be a potential delay in the process. Usually best practice, if everybody's working together and responsive and getting what we need on time, or if you know somebody and you have a relationship with a broker and agent there at your current institution and you reach out to them, that might help expedite that process. And then in the meantime, while we're waiting for the funds to come over, if you know already what you'd like to do investment-wise, then as Naveen mentioned earlier, you direct us and you complete the paperwork in order to make that investment. So we're gonna, depending on what it is you're doing, we're gonna tell you what investment documents are required. It's gonna be a combination of internal documents, like a direction of investment form that you'll complete for us with the details of your investment. And then we're also gonna need to review supporting documentation. So for example, if it is real estate purchase, purchase contract, that sort of information, we'll need a copy of the deed at some point. Title search and all that you can do, but we'll need that information. And we're also, I'm sorry, if you are investing in like a company and you're not doing the real estate purchase directly, and then you're just going to do like an equity investment, any sort of like partnership agreement or anything like that, we would need to take a look at. If you're lending, we would need a copy of the note to review. And that's a 2 to 5 business day review period. And what we're doing during that time is we're looking at that documentation to determine, is this something that we for sure can hold in the IRA? And then are the documents filled out correctly so that the IRA is named as the investor? It's labeled appropriately on there. There's not anything blatantly that we see would be considered a prohibited transaction. And once we've completed that review and everything is accurate and thorough, we will go ahead and process the transaction itself. So all in all, we usually say from first setting up an account, if you've never done this before, to the time you can process your investment, kind of around 4 to 6 weeks. And especially in real estate where things move fast, at least if you get an account open and you just have it open, there's not necessarily like a time period by which you need to get the funds in. So we don't like try to give you a deadline, but at least having your account established and kind of ready to go will give you a leg up and get you ahead of things when it comes time for you to identify your investment, get the funds moved over, and then get it processed by the custodian. So with that, I think, Erica, if there are any other questions, we can handle them, or Navid, if you had any other comments that you wanted to touch on or any perspective that you wanted to add, because I know that you have some experience with this over the years. I will open it to you, and then of course we'll leave this up for a moment for anybody who'd like to contact us and have a one-on-one conversation or just get more information.
Yeah, I mean, I could talk on and on, but I know we want to keep the time constraint. So let's just go with the questions. Actually, let's just answer those, to be honest.
Okay. So first and foremost, we have some questions about fees and costs involved. So I don't know if you want to go into that very briefly, but that was a very popular question that we got.
Okay. So costs involved are typically going to be a one-time setup fee, and then there's going to be a custodial fee. That's going to be the main fee that would apply to every self-directed IRA, regardless of what it's doing or what it's investing in. So the custodial fee covers the tax reporting on the account, statements sent out, all of the documentation and record keeping, ongoing service and support, online access, etc. So we, as a company, offer 2 options for that. Now, it may depend, with other companies how they structure theirs. But one option that we offer is a flat rate per year for each asset that you hold in your IRA. So you could have multiple investments in one self-directed IRA, or you could just have one investment. So you can either pay a flat rate per year, or the second option is a value-based calculation based on the total value of your IRA. So our fee schedule, I won't get into too much detail because I could probably talk about this for a while, but the fee schedule is accessible on our website under forms. So our website, nextgenerationtrust.com, and then forms. There's a whole library of documents there that you can take a look at. Fees are in there. It's just one page, but it does include a lot of different things that may or may not apply. But in addition to the custodial fee, anyone who has a self-directed IRA also pays a transaction fee at the time of their investment. So keep that in mind. And then there are some other fees that may or may not apply depending on what you're doing with the account. So when you consider the tax advantages, the custodial fees are really not that significant. The fee structure is different from your typical like brokerage account that you might have with Fidelity, for example, because they're typically advising you. So they're typically charging like a percentage fee. But since we're not providing financial advice, ours are just directly tied to like the custodial and administrative services provided.
Okay. The next couple of questions kind of relate to themselves, but it's in regards to tax penalties, which we can answer from an educational perspective. So the first question is, are you penalized for taking funds from the IRA to invest in real estate? And how can you take, or are there, I guess, ways that you would be able to take funds or withdraw, distribute funds from a Roth IRA before the age of 59 and a half? So I think here we're kind of getting a combination of a question of how can I withdraw from a Roth IRA before retirement age? And are there any other tax penalties that individuals should be aware of when they're investing in real estate using a self-directed IRA?
Okay, so if you're following the proper channels, excuse me, going through the custodian to invest in real estate, and then again, any maintenance and expenses are paid out of the IRA, earnings are going back in, you should not be subject to any penalties or taxes for that. However, if you are doing anything that's prohibited, as we covered earlier, and it can't be corrected for whatever reason, then the penalties and taxes can be steep. So you certainly want to educate yourself, work through your custodian. If there's something that is getting deep into the legal structure or complexities, then consulting with an ERISA attorney and having one in your network would be a good idea. We know of several that our clients have used for self-directed IRA investments if needed, so we're happy to share that information. But basically, if there's a prohibited transaction that can't be corrected, the IRA gets distributed to you personally as if you took a withdrawal. So depending on what age you are at that time, it could be subject to penalties, taxes, and/or even back taxes if the prohibited transaction occurred in a prior year. So that's definitely something you don't want to do. The other question was about withdrawing from a Roth prior to retirement age. So if you withdraw prior to retirement age, or 59.5 is the age after which you can typically take what's called a qualified distribution. If you take funds out of a Roth prior to that, you are typically going to be responsible for that 10% penalty and taxes. You still need to wait until that age to be able to take those funds out tax-free. However, there may be certain exceptions depending on your situation. The IRS may allow. So I don't say that with 100% certainty across the board. And usually in those cases, it's wise to speak with your CPA or your accountant about your situation to determine what your options might be.
Okay, and final question, I think we have a little bit of time for it. Do we have an IRA option with checkbook control?
Yes, so that was what I described earlier as if you wanted to invest in real estate, but you wanted the investment to be in the name of an LLC. We call that basically an IRA LLC. So how that works is a newly formed LLC has to be used. It can't be one that you already own. So it has to be newly formed. We do require you to use an ERISA attorney to set up the operating agreement so that it contains the right provisions and Internal Revenue Code references for the IRA. And then what happens is in that operating agreement, the IRA would be listed as a member. You as the account holder for your own IRA could be listed as a manager of that LLC. And in doing so, you get access to the business checking account for the LLC. So that's why it's typically referred to as a checkbook IRA or checkbook control, because technically the LLC is funded by your IRA, so it's a retirement account. But by being listed as a manager, you have quicker, more direct access to those funds. So that, for example, if you wanted to write a check at auction to purchase property, if you wanted to set up a debit card and be able to go to Home Depot to purchase supplies for your flip, you could do that through the IRA LLC structure. Just keeping in mind that it's even more important to follow those IRS rules and regulations to not perform prohibited transactions, because you have quicker access to the funds. You just want to remember those funds are not your personal ones. So you don't want to treat them as though they're your own personal funds by either paying yourself or lending to yourself or anything like that. They do need to still flow in and out of that LLC's checking account. But that is an option that can be set up. It just requires a few additional steps.
Okay. Well, that concludes tonight's webinar, or today's webinar, I should say. Thank you to everyone that joined live with us last time. And for anyone that's viewing this on demand, I hope that it was educational, informational, and a huge thank you to our co-host, Naveed, and obviously our Director of Marketing and Sales, Brittany. We hope to do this again soon.
I have one correction to make. My phone number is actually incorrect on the slide. It's 484-525-0010.
Okay. My bad on that.
That's all. So, all right. Thanks a lot, everybody. I hope everyone enjoyed it. And thanks, Brittany, for your time. Thank you very much, Erica.
Thank you.
Thanks for being with us.
Bye,
Take
everyone.
care. Bye-bye.